Is 0 hour approaching for the U.S. housing market? Will 0 and negative interest rates that are likely ahead of us in the near future prevent U.S. home prices from falling? We'll answer that question by taking a historic look at Japan's ZIRP rate policy and property values, and we're going to talk about why central banks rarely are raising rates currently. Hey everybody, JJ here. You're watching Bull, Boom, Bear, Bust. We won't talk about the stock market today. That's been the biggest thing, the biggest topic on most financial channels here this past week or so. Let's get back into some housing numbers. Now, before we get started, what is happening with home prices in the U.S.? Well, after a brief period when the Fed was raising the Fed funds rate and mortgage rates along with it also went up, at that time we had witnessed stagnation of home prices and falling home prices in a few cities, especially some of the more bubble price cities. But home prices are back on the rise again. Home prices up about 4% nationally year over year. And here's a quick shot of a national home price chart. This is year over year. Of course, this being a national chart, it's not going to show anything negative because home prices did not drop nationally when you compile all the different markets together. There were a few markets that did see falling home prices, but nationally we never did see falling home prices altogether, only a big slowdown of the growth when they were raising rates. But now it's on the uptrend again. Not only did home prices not fall nationally, now the rate of growth is even increasing. So year over year, home price gains are accelerating and getting bigger. And it has mostly to do with the low interest rates, low mortgage rates. Now, first of all, some of you may be saying, hey, JJ, why are you talking about the Fed funds rate when mortgage rates are not attached to the Fed funds rate? They can be different, right? Well, yes, they're not exactly attached. They're not always going to be the same. One could rise, one could fall at the same time. And Fed policies do not directly control mortgage rates, but they can have an indirect influence. When the Fed funds rate is lowered, or borrowing costs tend to fall for the banks in other areas, so that can have a big influence in what they're going to charge for mortgages. For example, take a look at this long-term chart with the Fed funds rate versus mortgage rates, and you'll see, yes, they don't exactly go hand in hand. They can move inversely for a short period, but over the long term, you can see there's an obvious correlation. So anyone that tells you that the Fed has no control or no influence on mortgage rates, don't listen to them. Deregulation of the banking system, loosening of the lending, and of course the rescue operations that have been happening within the banking system, taking risks away from the bank and taking incentive for banks to be choosy on who they lend to, taking that away from the bank as well. So let's get into the numbers here. Now, a topic that we've covered on this channel many times is the possibility in the very near future of 0 and possibly negative interest rates. And it doesn't always help the housing market, and we're going to take a look at what happened in Japan here in a minute. But it also can destroy a currency. Now, that didn't happen in Japan. They didn't see hyperinflation and a total destruction of their currency. They actually saw deflation. So it's very interesting when you hear this argument that there's going to be hyperinflation with 0 and negative rates. It's not always the case, right? Hyperinflation has happened in some countries. A couple we talked about here were Venezuela, Argentina, Zimbabwe, amongst others. And in the U.S., with the world's reserve currency, it may not be like that forever. And in fact, it certainly will not be like that forever. I also do not expect to see hyperinflation in the housing market. I do expect deflation, just my opinion. But let's take a look at what happened here in Japan. Let's start right here with this chart, and this is out of aboutinflation.com. We're going to try to link to this, by the way. And as you can see, going all the way back to the mid-90s, Japan has been cutting rates, and they cut lower. They were below 1% by the mid-90s, and since then, they have never raised rates above 1%. This is their central bank's target rate. So with such low interest rates, would you expect home prices to be rising? Well, many people would say yes. But when the Fed runs out of ammo and they can no longer cut, but, I mean, essentially 0% rates right here, 1% for over 20 years, what did that do to home prices? Well, this chart right here tells a pretty good story of what happened And we can look down and see what happened in the mid-90s. Japan saw a big housing bubble, inflated. That was actually through the 80s there. But throughout the 90s, decelerating home prices and finally falling home prices in the past few years up until 2018. It's not a completely updated chart, but you get the picture. Zero and negative rates do not always mean that home prices are going to rise. Now, it's not just about the mortgage rates and interest rates. It's also about the lending, the fractional reserve banking system, what the reserve requirements are for the banks, including underwriting guidelines for bank and non-bank lenders. And this could very well happen when this housing bubble finally does pop. It could happen here in the U.S. Even if they lower rates and go to zero and possibly negative, it may not rescue the housing market because people are so over-leveraged. Of course, a lot of other factors come into it, the things that I just mentioned a few minutes ago. But this should tell you at least a little bit about what could happen. Now, of course, Japan, they're a different country, different cultures, but math is the same no matter where you go. Just because it's Japan we're looking at doesn't mean 1 + 1 = 3. Here's another shot here of Japan's housing market. And yes, it only goes up to 2012, but remember, in Japan, they've had interest rates below 1% ever since the 90s. So we want you to look at what happened in the 90s. And it wasn't rising prices, it was decelerating home prices and a bear market actually dropping home prices when you get into 2010 through 2012. So why are central banks rarely raising rates? Because when rates are low and dropping, it gives the wealth illusion. Right? When people see their assets go up in value, they tend to feel like they're better off and they tend to borrow more and spend more because they feel like they can always fall back on their equity, or they feel like they can just sell if things get really bad. The problem is, by the time people realize that things are really bad, it's usually too late to sell because prices have come down. Just take a look at the last housing market in the United States, 2008. If you have waited to sell your home, would have been too late just in a matter of months. And you might have lost a lot of money if you waited until 2009 and later. Of course, home prices climbed back up again with the bank bailouts, the near 0% interest rates here in the U.S. for nearly 10 years. They finally tried to raise rates in the U.S. and they finally had to start cutting again because the economy, the markets started falling apart. And when countries are raising interest rates, it typically is after the dollar or their country's dollar has been destroyed. Let's take a look at an example. And we have reported on this a few times, but let's take a look at this article here, Financial Times. Argentina inflation jumps after pesos collapse. And what happened in Argentina, inflation got so high that it actually got up to over 50% over the course of a 12-month period. A 50% jump in inflation. So what did Argentina do to combat the inflation? Well, then they finally raised interest rates, and very drastically, I should say. All right, we'll go over to Wikipedia. Here's a list of countries and their central bank interest rates. We're going to see Argentina here. 68%, and it's been that way since October of 2019, just a few months ago. Now, why do countries and central banks like rising prices and high home prices in this case? Well, a lot of reasons. It does give people more confidence in the economy. It gives homeowners more incentive to spend, more confidence, which also is another way to boost the economy artificially, but it is a way to boost the economy through spending, but also higher tax revenues. And then the question comes up, well, why do they need taxes if they could just print money out of nothing? It's all fiat central banking. So there you have it. Low and zero and negative interest rates may not keep this housing market propped up. Of course, anything's possible. This is not set in stone. But I hope this gives you a pretty good idea of what could happen, what's likely to happen based on what happened over in Japan. Thanks everybody for watching today. Please subscribe if you haven't done it already. I appreciate all of you being here. Ride the bull, prepare for the bear. Bye for now.